So, we studied governmental funds. We took a stab at the proprietary funds, and today we'll cover fiduciary funds. This also happens to have an area which is one of the most complicated in governmental accounting, which is pension accounting and reporting. We'll cover some of it, but not in the depth that it really should be covered, because it's really beyond this course itself. But let's talk about a couple of things just to put this all in context. What you're going to realize is, the first thing is that fiduciary funds, does the government have a stake in it? Do they own those funds, or what's the story with those? They are in trust, right? They're kept in trust, and for that reason, do they show up in the government-wide statements? No, they don't. What basis of accounting do they follow? Accrual basis and economic flow of resources. So we're going to try to understand the 4 different instances of fiduciary funds. We'll look at one agency category, and we'll take a look at trust funds, of which there are 3. Okay? And we'll do the easy one first, and then we'll move on to the others. And these are the 3 principal trust funds that we'll look at: investment pool, private purpose trust, and pension trust, which really the numbers are so staggering that everything becomes almost minuscule. And then we'll take a look at this, as I call it, a time bomb, post-employment benefits in governments, because there's this liability outstanding which nobody wants to actually see or recognize, and we'll talk about that. So the first thing what we'll do is talk about agency funds. Now, there were some things that I talked to you about agency funds. First of all, they are assets held by a government acting as an agent for one or more other governments, individuals, or organizations. And for that reason, government holds those assets in a custodial capacity. The word is custodial capacity. They're held, and then they are given to the individual or organizations for whom they're held. And for that reason, if you look at the balance sheet of an agency fund, what do you find? Assets and liabilities and no net position. So assets equal liabilities, and that's it. And because you have no net position, it means you have no revenues and you have no expenses, because revenues minus expense give you net asset or net position. But if you don't have it at all, you know you have no revenues and you have no expenses. And we'll take a look at some examples of this. Now, GASB is, people use agency funds for a variety of purposes, but these are the guidelines by GASB as to when they should be actually used. Okay? One of the questions which I'm always asked is the difference between, as we'll get through this, between an agency relationship and a trust relationship. Trusts are more formal, are longer term, are large. Agency funds tend to be smaller, shorter term. There are no complicated trust agreements involved. And we'll take a look at 3 instances of agency funds. These are the 3 instances we'll take a look at. And the first one is special assessment accounting, where the government is not obligated in any manner. The word is not. Everybody remember what special assessments were? I know this was back from debt service fund area. Nina, I think did you raise your hand? Did you want to answer this question? Okay, maybe it was Humera. Yes. What do you think special assessments are used for? Well, special meaning the assessment carried out on a group of property owners who benefit in some way and have to pay a special tax. Want to add something more? Okay. So special assessments, let me just remind you what it is. Special assessments are involve an area where you have property owners who derive a certain benefit. And for that benefit, they need to pay a tax. What could that benefit be? It could be construction of a sidewalk, construction of roads, whatever it might be in a development, for instance. And what they do is they ask the government to do that for them, and they pay the government for undertaking that development. Why don't they do it themselves? Just like we saw here, what you have is it's hard to get all property owners to agree on one thing. So they all agree on letting the government decide to engineer the project and build the project and do it in the cheapest way, okay? And then they pay the government for undertaking that through a special assessment. When the government is on the hook for special assessment debt, it's carried in the debt service fund. But when it's not, it's carried in the agency fund. So that's one. Tax agency fund, and we'll talk about this very shortly, are where a government collects taxes for other governments. It's temporary. They collect them, and then what do? They distribute them. Why would they do that, by the way? Why would one government collect taxes? For instance, take New Jersey. When you get your tax bill is divided into 3 areas: schools, municipal, and county. Why does one entity collect for all 3? Well, it saves money. Rather than every entity billing for each one of their portions, what do? They all combine it in one tax bill, and when the government gets it, they send it to the schools, they send it to the county. Now, in many states, unlike New Jersey, it's a little different, because in New Jersey, you have the towns collect taxes. In many other parts of in the country, it's the counties that collect taxes and then remit it to the towns, okay? And then we'll talk about pass-through agency funds, which are grants, which we'll talk about shortly. You'll see in the book, there's this whole thing about, when government pays its employees, what do? They withhold taxes, right? And the taxes are remitted to the federal government or the state government, right? Should we run that through agency funds? Really, you don't have to, because it's such a short-term thing. There's too many complications involved. Accounting for one, so they run it right through the governmental fund. But if you see that elsewhere, that's one of the functions of the agency fund. But for expediency, people don't do that. So let's take a look at special assessment agency funds. As I said, it's no more than what I just told you. Group of property owners benefit from some construction project, and then they pay the government for it. And if you ever come across a question, and I ask you this question, where should special assessment debt service be accounted for? An agency fund or debt service fund? The question you want to ask me is, who's responsible for the debt? If my answer is the government, where would it go? Debt service fund. If I say it's the property owners, government has no involvement, then it goes to, just remember that, and that's the most important thing to keep in mind. And this is an example where the government is not on the hook. They basically get the money from the property owners and send it to the bondholders. And this is the same journal entry that we saw back in Chapter 5, okay, which is we debit a receivable, in this case, defer the principal for the next 9 years at $900,000, and each year we make the deferred portion into a current portion. So see that the first year this becomes current, the next year out of this 100,000 will become current. Here cash is being received for the principal plus interest at 5%. 5% of $1 million is 50,000, so they receive 150,000, and now they need to pay 150,000 to the bondholders. It's straightforward journal entries, collecting from the property owners and distributing it to the bondholders. By the way, in reality, not many special assessment funds go through agency funds. Because you know what? Do you think anybody is going to buy bonds without the government backing those bonds and saying, oh, you know what, we'll just rely on the property owners to pay us? Do you think anybody would? It's going to be a hard sell. So that's why, even though the example is here, but in real life, things can be a little different. And then, as I was saying to you, each year, this journal entry takes money out of the deferred and puts it into current. Okay? No more than this. Don't make it more complicated. That's all it is. Next example is the tax agency fund. Now, this is an example. The tax collector collects taxes for these people. I mean, these entities: Delta City, Delta R5, school district, and county's own general fund. So taxes are being collected for how many entities? 1, 2, 3, and 4. Got it? So they're collecting for themselves and 3 other entities. And they charge 1% to the others. To the other 3, Delta City, Delta R5, and the school district, for doing this for them. Okay? This is the annual levy for the general fund for each government. $250,000 for Delta, $150,000 for school district, and $100,000 for the county itself, right? I'm sorry, did I say 4? It's really 3. Delta R5 consolidated school district. Yes, it's 3. Delta City, Delta R5 school district, and county's own general fund. Not 4, but 3. Okay? Bless you. So we have 3 of them: Delta City, school district, and county. Notice what we did. We came up with the percentages. Why? Because now every dollar that's received, how do you distribute it? 50% goes to Delta City, 30% goes to the school district, and 20% goes to the county. But there's a 1% charge, right? So what do you do? Of each dollar, you take what? A penny out, right? And then distribute it, right? In that proportion. So let's see how that works. And there are tons of journal entries here. You really, first of all, let's set up the receivable. Agency fund, no revenues. A due from taxpayers and a due to everybody else. See that? Due from other funds or units and due to other funds and units. Okay? Now, this is, remember, in Delta City General Fund. This is not an agency fund. This is in the general fund. That's why we can have revenues. It's in the general fund, right? This is what they show. 4% of tax levy on their general fund. Why this? What you'll see is you'll see these range of PowerPoints. All of them, they deal with each of the entities separately. That's why there are so many of them. One looks at it from this perspective. The other one looks at it from the school. The other one looks at it from the county. That's why make sure that you read the heading. And this is their one for the next one, for the general fund, school district. And this is for the county. This is what they booked on their accounts. These entries are not being made in the agency funds. These are being made where? In the general fund of each of these. Okay? This is the important thing to keep in mind here. 250, 150, this is the proportion. So they're going to pay what? $3,200 to the county for the collection efforts. Everybody see that? County is collecting for them, and they're going to pay $3,200 to them for that. And this is the net that they'll realize, except for the county, which makes off a little better because they're collecting administrative fees. Is everybody clear? Okay. And then these are the entries as they collect the taxes. And I'll show you an example. $400,000. It gives you the amounts to each one of them based on the schedule that I showed you before. Okay. And I'm going to go through this quickly because these kind of explain themselves. The cash is being distributed to these three. First it was received, now it's being distributed back to these three. What you'll notice is every transaction in agency fund affects an asset and a liability. So if your asset goes up, what happens to your liability? Goes up, right? And same thing with that. So all transactions will impact either an asset or a liability account. Again, you can follow this through. As I said, there are many, many slides here. And notice how they, in the general fund of Delta City, how they show administrative costs, expenditures. It would have been nice if I had added the word expenditure administrative fee for collecting taxes, right? But that's what that is, $2,000. Okay. And again, you see that on the other ones, and this goes on and on. And there, I think there are quite a few journal entries here, but so the what did we do? Let me just quickly summarize this. You have one entity collecting taxes for several entities. That entity is getting paid an administrative fee. That administrative fee needs to be collected each time they receive monies. And then you need to distribute the revenue, the amounts of taxes to everybody else based on that percentage, 50%, 30%, and 20%. And that's a tax agency fund. Then we have these next category, which is the pass-through agency funds. Now, what are these? So what are government grants, by the way, again? What is that all about? What are government grants? Give me an example. What happens, what's the story about grants? Let's say if the federal government decided to give a New Jersey municipality some money because of the hurricane, because of the storm. So the federal government gives what? A grant, right? And remember the two questions, always the question is what? What purpose it's for and when can it be spent, right? And whether I need to spend it first before I get reimbursed, right? Those are the questions. So let's think about this. So the federal government sends a grant, wants to give a grant to a local municipality. The grant has to flow through the state of New Jersey. The state goes through the state of New Jersey to the municipality. That's called a pass-through grant. Why? Because it's passing through what? Through the state to the local municipality, right? To the local town. What if the grant went directly from the federal government right to the local town? It's not a pass-through grant. So now you say, how does that agency fund get involved in here? Well, this is what happens. If you were the state of New Jersey and you had a grant that came, and I'm just making this up, for a local town down the shore to rebuild their boardwalk or something like that, and the federal government gave you $10 million to give to some of the towns at the shore. And it said, you know what, $1 million for Asbury Park, $1 million for Long Branch, and they give you all these and they tell you this is, but we're going to send you the money and you give it to the towns. That's a pass-through grant, where when the state shows that money coming in, is that revenue to the state? No, it's just what? It's coming in and it's going out, and that's why it's in the agency fund. Now let's change things a little bit. What if the federal government said, we'll give you $10 million for these towns, but you know what? You need to figure out, state, if they really need this money? Or how should it be spent? There's some involvement now on the part of the state. Or we'll give you the money, $10 million, but you know what? You need to put up $5 million. That's called what? A matching requirement. If there is any kind of administrative involvement or matching requirement, there's no longer a pass-through grant. Then it comes in as revenue and goes out as expenditure, because the state has the ability to change the disbursement of those grants. Okay? And this is what this talks about. See the word administrative involvement or direct financial involvement? Administrative involvement is selecting the recipients. The federal government says, here's $100 million. State, you decide who should get it. Well, that's administrative involvement. Okay? So, and financial involvement is, we'll give you $100 million, you put up $25 million. That's the, yeah, Andrew. Well, it depends on how the grant money is received. In many, many cases, you have to spend money first. And that's, you know, federal government's very smart. They don't give you the check beforehand. You need to usually, most of the time, spend money. And even then, people are very happy. Because at the local level, you can always issue a note, right? Like a bond, tax anticipation note or something, to some kind of a short-term borrowing to fulfill that, okay? And that's what actually what's happening right now down the shore with all the work that's being done. Did anyone read the story in the Star Ledger this Sunday, was it? About $1 billion worth of ratables being wiped off the town's tax rolls. We were just talking about it. And I didn't know that's how large the number was. It was in the Sunday Star Ledger, right on the front page, that $1 billion of tax ratables have been wiped off because of the storm. And when they get wiped off, what happens to taxes? They disappear. Now what happens to the budgets? They're in trouble. Somebody has to bail them out, right? And this is the story that we, you know, which was there in the paper. Okay, let's take a look at some statements. Now this is on page 50. It's a little bit more manageable than some of the other statements you'll find in the CAFR. So let's take a look at the first statement, which is the statement of fiduciary net assets or position. This is for City of Jacksonville. Now, the first thing which I want you to notice is comparative basis. See this? Always 2 years are shown, right? It's on a comparative basis. What are the three different? I gave you, actually, there were 4 funds which I mentioned to you. There were 1 agency fund and 3 trust funds. The 3 trust funds were investment trust fund, private purpose trust fund, and pension trust fund. So if you don't, apparently Jacksonville doesn't have investment trust fund. They only have 2 types of trust fund. That's why you only see 3 there. You'll normally see 4 altogether. Now, notice the agency fund. Everybody see this is the easy one. Go down. Any net assets in the agency funds? No. Asset equal liabilities, right? So you notice that the other thing that you notice is, and I don't know if you can see this clearly, but on the left-hand side, you see any capital assets, real large capital assets? Well, there is this little thing here, right? Apparently, fiduciary funds don't have a lot of capital assets. Why? Because they're mostly what? Investments and financial assets. They don't have, you know, large amounts of equipment and things like that. And that's why capital assets aren't that many. All right, let's take a look at the next page, which is the changes in fiduciary net assets or position. what do you see? This is on page 51. Additions, not revenues, but what? Additions. And what do you see here? Deductions, not expenses. Notice the difference in fiduciary statements? And again, we'll go through this a little bit more in depth. But this is an interesting statement because this is one of the harder statements to read, by the way, because it has so many things here, and mostly it's all investments and financial assets. So what are fiduciary funds again used for? One of the largest uses is for pensions, and we'll talk about that very shortly. We'll cover the easy parts first. And pension, as you can see, when you look at the pension trust fund, look at that compared to the private purpose trust fund, and you don't even know what that is with the private. Look at the private purpose trust fund as opposed to pension trust funds. Look at the net assets of the pension trust fund. And I believe this is in thousands. So you're talking about $2.5 billion, right? Large numbers, huge numbers in pension funds. Okay? So when you look at these funds, what you'll realize is that the pension funds dwarf anything else, except for maybe investment trust funds, which we'll get to in a moment. Okay. All right. Any questions so far? Okay, so these are the three types of trust funds that we will take a look at. The first one being the investment trust fund, and then we'll take a look at the private trust funds, and bless you, and then we'll take a look at the pension trust funds. Okay. Just a quick review. Again, for trust funds, government acts as an agent or a trustee for individuals, which means the following. If you were working for a government, like hear the story yesterday about city of Stockton, county of Stockton, declared bankruptcy? Okay, now so let's assume, Justin, you worked for them and you had your pension. You've been working for them for 20 years and you've got your pension vested with them. The creditors come after the city. What happens when things are in trust for a government? Can the creditors get to those pension funds? No. And that's the difference, is when items are within the trust funds, because basically what we're saying is they're not owned by the government. So the creditors cannot lay a claim on the assets of a pension fund. They're protected. Okay? And GAAP requires accrual accounting. We talked about that. And the other thing which you will notice is that everything that's shown here is reported at fair value, market value. And boy, can they affect things quite a bit when you use fair value accounting. Right now everybody's happy, the market's up, fair value's up, but when things go the other way, just think about what will happen, all those bond portfolios, if the interest rates rise. What happens when interest rates rise? What happens to the value of the securities? They go down. And right now, we're enjoying the low interest environment, and that's what everybody's afraid of. Okay, let's take a look at the investment trust funds. Now with investment trust funds, I'll give you a simple example right from New Jersey. New Jersey has something called the New Jersey Cash Management Fund. It's a money market fund. New Jersey has over 500 municipalities, 21 counties, 1,000 authorities, many units of government. What do they do with their cash? If you are the CFO, do you just stick it in the bank and say, all right, I'm not earning anything, I'm happy, You, for a large city like city of Newark or Jersey City, what do? Do you just stick it in a bank and hope for the best? Or do you call up one of the investment banks in one of the banks in New York and say, well, will you manage this money for us? Would you take care of this? Well, there are very strict laws and requirements as to how and where governments can put their money in New Jersey. You just can't call up your friend in Citibank and say, or some other Citibank, well, let's take a bank which is out of state, which is headquartered out of state, and say, you know what, I'll put deposits in your bank. Can't do that because they have to be registered under, and I won't go into this, it's Government Unitary Protection Deposit Act. There is a law in New Jersey which requires banks who do business with state government and local governments to have certain levels of deposit and security in the state. Because if something happened to them, the state can go after those reserves. Okay. So what happens is that a lot of these towns and municipalities and states want to park their money somewhere. So what the state decided to do was, through their division of investments, they hired some very smart people and they set up their own money market fund or their investment trust fund. Now, what they did was when they set this up, this money market fund, they said anybody, any government in New Jersey can put their money there and no questions asked. If you put money in the New Jersey Cash Management Fund, we have no problems at all. Anybody in New Jersey, because we are running that fund. Okay. Now, with investment trust funds, there are two things to keep in mind. There are internal participants and external participants. And this is one thing I want you to remember. If New Jersey, state of New Jersey, is running the New Jersey Cash Management Fund, and the state puts its money in the cash management fund, it's an internal participant. It's part of the state itself. However, if a town or a county puts money into the New Jersey Cash Management Fund, it's an external participant because it's not the state itself. It's another entity, even though it's within New Jersey. Now, why I bring this internal and external is investment trust funds are used to show activities of only external participants, not internal participants. The internal participants' activity would show up in the governmental fund, not here. So this shows only the activity of the external participants. The book has a series of journal entries, and I don't think for this class, for our purposes, I won't hold you accountable for those journal entries. Okay? They are basically what they deal with are purchases of investment, sale of investment, realization of income, and changes in fair market value. Okay? I don't think we have to go into that depth, but you do need to know the general concepts of how and when an investment trust fund is used. Okay? Yeah. Internal participant would be the state of New Jersey itself because it's running the fund itself. So it's an internal participant. Everybody else who's not the state becomes an external participant. So what I'm saying is these external participants are shown in the investment trust fund. Because why? Because they don't belong to the state. Their own position is shown in their own governmental funds where the creditors can go after. But others people's money has to be shown in the investment trust fund. That's the point. Yeah. So everybody understand the concept of the investment trust fund, and a very, very important part here is marking all the investments to fair value. In fact, every day, if you've ever invested into any of the money market or any other mutual fund, what do you see? Every day they mark their investments to market at the end of the day. Can you call up in the middle of the day Vanguard and say, oh, you know what, I want to purchase your shares, but could you purchase them as of 1 o'clock? No. They'll always tell you what? At the end of the day, whatever the value is. I'm not talking about buying stocks. I'm talking about investing in a mutual fund, right? So because they mark it at the end of each day so they can track properly who's got what. Let's talk about private purpose trust funds now. The private purpose trust funds are interesting. Again, keep in mind what we just talked about, which is that so if they're private purpose trust funds, there must be public purpose trust funds, right? What does public purpose mean? For the general public. What does private? Maybe certain individuals, right? If you get that meaning, you've got half the story. All right? So let's think about this again. A permanent fund, remember permanent fund? Where the principal is kept intact and you only distribute the earnings or spend the earnings. It's used for what? Public purpose, right? Like state of Alaska, sending a dividend check to everybody in the state, right? At the end of each year, right? And so that's what? A public purpose. What if you can spend both principal and interest? Then it comes through special revenue fund, right? If it's public purpose. Now let's go to private purpose. So you've got somebody who gives you $100,000 and says, you know what, this $100,000 I'm giving to the town, but it's to be used only for the children of firemen and policemen who live in this town or who have died. That's it. Even though you're using those monies for certain folks within the town, it becomes a private purpose trust fund because you have designated who's going to get the money. So your question is, can I spend both the principal and interest? It doesn't matter. It could be one or it could be both. It would still be a private purpose trust fund because somebody's given you money for a certain purpose, right? So anybody else give me another example of a private purpose trust fund where you might have come across something where, you know, because you need to, yeah. A what? Yeah, yeah, exactly. Exactly. It has to be something specific and not for the general public itself. Okay? Keep that in mind because you'll come across this question. I'm going to ask you to distinguish between public and private purpose, and I'm going to give you examples, and you have to figure out whether it's public or private. Okay? So keep that in mind because the difference is, and the only reason why I make it a big deal is because the public purpose are not shown here. They're shown where? They're shown either in the permanent fund or they're shown in the special revenue fund. But if it's private purpose, it's shown in the fiduciary funds. Okay? All right, so, and as you will see by the size of, I mean, there's not a whole lot of money, right? $15,000 in private purpose trust fund. There's not a whole lot of money. So you don't have, so it's one of the smallest things. What I like to say is sometimes what people do is they figure out if the funds that they're dealing with are public purpose or not. Usually, if it's not public purpose, it's not pension, it's not investment, it's not agency, they just throw it into the private purpose trust fund. It's like process of elimination. Okay. All right. Any questions on this, by the way? Now we'll come to the real So they're a real important part of this. And these are some hints on accounting for endowment funds. Is similar to accounting for permanent funds. And what everybody know what expendable word mean? Where you can spend both? Yes. Yes. Oh, actually, you know what? Good example, Nina, because let's take Rutgers for a moment. All right? Let's assume that Rutgers receives, as they just received, $1.5 million from Prudential. Okay? They just got it. I saw it the other day. For Institute for Ethical Leadership. Okay? $1.5 million. And let's say, and I don't know the details of the grant, but let's say that $1.5 million was given to them, and they were told that they could set up, this chair, which is to hire a renowned faculty member to teach at the university. That's an endowment where the $1.5 million, now we probably need more than $1.5 million, to be able to use the earnings from the endowment to hire a professor. So endowment usually, in most cases, the principal is kept intact, and the interest or earning can be used for whatever purpose. In the case of Rutgers, the $1.5 million is given not for any other purpose at the business school. It's given for a certain purpose, which is for either hiring a professor or using that money to do something. So that becomes a private purpose trust fund. Yep, exactly. And that's how that would show up. Yep. That's why big universities like Harvard, you hear about their endowment. How much do you think Harvard has as its endowment? Anybody know? You know what? Somebody's got a computer. Check it out for me and let me know what the endowment for Harvard is. Because I know it's some big number. And the reason why I make it a big deal is the endowment does a lot for the university. It not only pays for the faculty, but the endowment is used to subsidize the cost of education, meaning those scholarships, reducing the tuition, all of that occurs. So the size of the endowment is very, very important. 32 billion? Wow, that was fast. Now think about it. They have an endowment of $32 billion, and they are to use the earnings from that endowment. Now just assume for a moment that the earnings were $1 billion just from the endowment. And that's why, the joke is that if you took just the earnings from the endowment, every student that went to the school would go for free. But they need to charge. You see that? But thanks for checking that. Okay. Well, no, endowments usually don't want people to spend the principal. But in certain cases, like when we had the market downturn, some of them got really hurt and ended up taking some of that. But usually, most of the cases, all the big universities like Harvard and Princeton and Stanford and all these guys have huge endowments. And as I said, if you really looked at the size of the earnings from the endowment, you could literally, every student who attends could go for free. But, I'm not into that kind of school, university-related finance stuff, but I can tell you that's why, when parents look at it, what do they say? They say, wow, with that endowment. But that's the reason why Harvard has this policy, is that if you get accepted into Harvard, you will never, your inability to go to Harvard because of financial issues should never be a question. So if you're accepted into the university, you're going to be able to go there. Okay? The question is getting accepted into the university, right? Yeah.
Just to give you an example about the private purpose fund for the university. So does the university have a public purpose fund?
Well, universities, remember, unless it's a state university which does something for the entire state, then it would be public purpose and it would go into a special revenue fund. Or usually they don't have permanent funds, but in most cases it's usually like a private purpose trust fund. Yeah.
So public purpose fund only for the
Basically for towns and municipalities and state, but universities are different in that way. Okay? Yeah. All right. Let's do a quick introduction to pensions and then we'll take a quick break. Okay? So this topic is, of all the topics within fiduciary funds, is probably the most important. And it's also the most complicated. And what makes, unfortunately, will make things a little complicated for us is what's in the book. Well, last year we had new pronouncements from GASB which changed pension accounting and reporting. So I'm going to try to, what I did was I uploaded a separate presentation from GASB on the new standards and how they will change pension accounting and reporting under this week's course material. It's just a few slides, so make sure you go take a look at it. I also uploaded a link to a 60-minute, the program on CBS, on what the governments are dealing with as far as pensions and these other things called other post-employment benefits and some other links. So you might want to, if you get time, to make sure you look at this. So that's the context I'm going to present to you the material, and I'll tell you the areas where things are changing. And this is it's kind of difficult for me because I was trying to figure out, if you take the CPA exam next year, let's say, I'm not sure whether the exam is going to test you on the old pension standards, which would have already been, they were gone last year, or on the new. So we're going to try to study both of them. Okay, so this way you'll understand it, because pension is an important area. All right, and it's not, even though I tell you that it's a little complicated, but I'll try to make it as simple as possible as I can. Okay, so let's think about pension. When you start working, what's one of your objectives? I know this is too early to think about retirement, but what is one of your objectives? That at some future point you have what? Some kind of a income stream coming in, right? That income stream, let's not call that Social Security. Let's call that some kind of pension. I hope it will be there, Social Security will be there, but let's not count on it, okay? So there is this pension stream, which is this future income stream that's going to be coming. How does that work? Anyone explain to me, how does it work that you get money when you're 67 years old, a certain amount every month, and you're home relaxing, or in the winter in Florida, and or in March watching the game in Tampa? I mean, how does that work? Yeah. Excellent. So you take some money from your paycheck, and you're hoping some money from the employer, right? You take that money, you put it into some kind of a plan, right? We call that, by the way, the technical word for it is defined contribution plan, right? And basically what you do is would you want to invest that money yourself? All right. Now he just said something interesting. He said, I'll put some money in, my employer would put some money in. So let's say I made $100,000, and I could put up to 8% of my pay into a plan. So I put 8,000, and the employer will match it by another 8%. So if every dollar I put in, they'll put $1. So now I have what? 16,000. So I asked him the question, okay, $16,000, who holds the money? He says, well, I'm not sure. Then I asked him, who invests it? He says, well, I don't want to invest it. Now, some of you, how many of you would want to invest it yourself rather than leave it to somebody else to invest? Okay, not many, interestingly, because you know what's really funny? When I did this stat, now I didn't do it for the PA class many, many years ago, it was exactly the reverse. Market was going crazy. People wanted to invest the money themselves. They didn't want the employer or the state to be doing that for us. So and then we'll stop, take our break. You have two options. One is, which is now in common because the employers have gotten really smart, $8,000 he puts into his account, $8,000 from the employer, $16,000. Employer says, here's our $8,000, there's your $8,000, put it into a pension plan, and we never want to hear from you again on this. You are in the driver's seat. You have to do what? Invest. And you have to invest it in a way that at the end, because it's tax deferred, you're not paying taxes on this, at the end, you will have a steady revenue stream. So think about it, $16,000 a year, right? Remember those present value, future value tables I was talking to you about, right? So what do you want to do? You want to calculate the future value of an annuity. Let's say you earn 6%, at 6% for 35 years. And it will give you what? A lump sum amount when you hit 67, right? So now you've gotten that lump sum amount. Once you are there, then what do? You calculate the present value of annuity over 20 or 30 years for your lifetime to figure out how much you should draw down, right? See how these tables work? They can go both ways, right? So now you have this scenario. Now there are other people who think about this differently. And they are the ones mostly in the public sector. They say, you know what? Take my $8,000. Invest it any way you want. All I want is when I'm 67, I want you to pay me whatever, let's say $4,000 a month, every month. I don't care if you make more money or less money. All I want is when I turn 67, I need that $4,000 from you. That's called what? A defined contribution plan, and that's what we're going to be learning next. Okay, let's take a quick break, and then we'll finish this off. Okay, let's settle down. We'll get started. Okay, so what's going to be happening is with that. So now with that introduction to pensions, let's talk a little bit about pension accounting. And what I want you to do is, and this is a little difficult getting from the book, but I want you to keep this in mind as you read the text. When you read about this subject, there are two lenses that you're going to use, two different ways of looking at things. One is look at it from the way of the government that's participating in the pension plan itself, the employer. And then look at it from the way of the people who are managing the pension trust funds or are involved, the state, which is being run through the fiduciary fund, okay? Because remember, in the fiduciary fund, you're going to see the pension accounting occurring from the perspective of those who are managing those pension trust funds. And the government, which is contributing those pension funds to this primary entity, is going to do accounting differently. So what we're going to talk about are these areas: pension expenditure, expenses, liabilities, assets, note disclosure, and the required supplementary information itself. Okay. So who does this apply to? It applies to all government-owned or affiliated healthcare facilities, colleges and universities, public benefit corporations, utilities, pension plan themselves if they're also employers. This is where the accounting standards apply to. Now, what we're going to be talking about mostly is the defined benefit pension plans. Okay. Once again, what were the two different plans? They were the defined contribution plan and the defined pension plan. Defined contribution plan is very simple. You put in the money, the employer puts the money, you take that money and invest it. Is the government involved in managing that money or setting up a pension trust? No. And that's why more and more governments are drifting towards defined contribution plan instead of defined benefit plans. Okay? And that's why GASB standards provide guidance for defined benefit plans that are either part of the employer's financial report or included in a standalone report. So this is the story. Let me just give you a preamble to make, because you're going to have a little difficulty trying to understand this. If you were the state of New Jersey running a pension plan for the thousands of employees in the state, school district employees, public employees, firemen and police, judicial, they all have their own pension plans. Big responsibility. Huge pension plans in billions, tens of billions of dollars being managed. The question is always, do I have enough money to pay the pensions when they come due? And this is what you need to keep always in mind. The pension accounting revolves around the ability to make those payments. All right? And therefore, now just follow me closely here. You're the pension plan, you have assets and you have liabilities. Liabilities in the future, assets today. Without knowing anything about pensions, can you give me a formula of how I can meet those liabilities? If I have some pension assets today, what do I want? The earnings on those assets plus continuing contributions from employees should equal what? This future liability, right? Those are the terms you will see in the book. Okay, these concepts you will see. Always, what do you want to do? You want to have assets, and in other ways, think about this. If you work for the state of New Jersey, not only do you get your current paycheck, your current compensation, you get deferred compensation. How is that? Pension payments in the future. Now think about it. From an employer's perspective, I'm paying you your current salary of $80,000, but I have to do what else? Pay into the pension fund for your retirement in the future. If you understand that concept, you've got it. If you don't understand it, you're going to have trouble. Okay? So your total compensation is made up of cash that you receive today and your employer putting some money on your behalf into a pension fund. Why I'm giving you this long-winded story is for the following reason. The problem of why we have such issues with pensions is that the employer is not putting the money for you. Now you say, what happens if the employer doesn't put money for me? The employer has guaranteed that when you reach 67, you're going to get your pension. By the way, you know how that's calculated for a defined benefit plan in the state of New Jersey? This is what happens. Let's say the retirement age for the state is, and I know for Social Security it's 67. For you it might be later, might be 85, but no, I'm just kidding. But you know, it is 65. So if I were working with the state of New Jersey and I was 63 years old, I'm 2 years away from my pension, meaning at 65 I can stop, and every month for the rest of my life I will get a check. It's like a money truck going with me everywhere I go, right? It's your pension, you earned it, right? The way the state calculates this is they take into account, not that you have to know this, but you might be interested as to how public pension funds calculate how much you'd get. You take the number of years you worked in the state. Let's say you spent 30 years, very long time. You take 30 years, divide that by, there is a fixed denominator, which is 60. So 30 over 60 gives you what? 50%, right? Times your final salary. In New Jersey, it's the average of the 3 highest years that you earn. So if you made 100,000 in 1 year, you made 110,000 the second year, and 120,000 the third year, your final average for the 3 years would be what? 110. So it would be 50% of 110, $55,000 every year for the rest of your life. That's how pension payment is calculated under a defined. That's a real example from New Jersey, okay? Now there is cost of living adjustment. The state postponed it. But this all can happen. You don't care. You're going to get that money because you have an implied contract. But what if the state doesn't put the money into the pension fund? Where are they going to come up with that money? When the state doesn't put money into the fund, that's called, and you'll read in the book, an unfunded actuarial accrued liability. It's a UAAL, which is a liability which hasn't been, which is out there, which is not funded. Okay? These are different terms that we'll talk about shortly, but I want you to just understand the concept. So you have assets and you have liabilities. Now I want you to think about it this way. So every year the state, and I won't go into the actuarial calculations, but you know, there are calculations which tell the pension people how long is a person expected to live, male and female. Okay? And based on that, they calculate the amount that's needed from you and from the employer every year to fund that pension plan based on a investment rate of return. It's no magic. That's how it's done. Okay? So let's just assume from your paycheck every 2 weeks you have a little code there. It says PERS, Contribution to Public Employee Retirement System. And you say to yourself, geez, they're taking $500 from me for PERS. Now the state of New Jersey in lump sum is required to put in several $100 million as a match. What if the state doesn't put in the money? What's happening? Now in the future, the state will have to make that payment on something called pay-as-you-go. By the way, what I just described to you, the terms, the first is the amount that's required of the state, that's called ARC, Annual Required Contribution. The amount they contribute, if it's exactly the same, you should be happy. But most of the time, in many states, it hasn't been the same. They have said, we've got more important things to do than put money into the pension retirement system. And you say, but that's not legal. Yes, states can do it. If you're a private employer, you could not, but the state can. The difference between what they're expected to put in and what they should have put in is called NPO, okay, which is net pension obligation. Again, you'll read about this. NPO, which is the difference, the shortfall, okay? What I want to do now is give you an example. This is from the net asset, from the statement of net position. See this figure here? I don't know if you can read this. Net pension obligation, $16 billion. Net OPEB, and we haven't talked about another unfunded obligation, 12 and 16 billion. See these numbers? Now why I bring this to you is when you look at the CAFR, that project you're doing, when you come up with your conclusions, you're going to be looking at these numbers. We have $12 billion in net pension obligation, or amounts that should have been put in but were not put in. And I haven't even told you what OPEB is, but that is 16.8 billion. What does that do? By the way, for those of you, anybody doing New Jersey here, the CAFR? Okay, I was going to ask you if you can tell me, do you ever see a balance sheet which has other, and look at the amount. Ever see a balance sheet with other? There are some numbers in there. It just doesn't come up, okay? 38 billion. But think about what this does. Because remember, when this number goes up, what happens to the net assets? Okay, look at what happens now. Look at state's net position. See that? What is that? That's a negative $40 billion. Do you see why this is of concern? And as you look through other CAFRs, I want you to notice this. And in your presentation, talk about it. There are states which don't have this problem, and there are other states which have serious problems. And that's why pensions is such an important topic. It just kind of overblows everything. Okay? So that technical term which I just gave you, NPO, shows up there. Okay? Now, and that's the reason why GASB is making the changes that they are. Okay? So let's go back to this here. There are 4 statements that you will find. A statement of planned net position, a statement of changes in net position, a statement of funding progress, and a statement of employer contribution. And let me just see if I can get to them so you can just take a quick look at them, because for Jacksonville, it's pretty straightforward. Okay. This is the statement of planned net position for the employee retirement system. By the way, the word public employee retirement system usually denotes that. And I don't know, I think there might be a slide, but I want you to understand that pension plans come in different flavors. And what are these different flavors? You could have one pension plan for one employer. What is it called? A single employer plan. You could have one pension plan for many employers, which is called agent multiple employer plan. But that plan, each one has a little account. Each one's pension, you know, this agency's assets are $1 million, this one has $2 million, this has $3 million. And then you have the third plan, which is multiple employer cost sharing plan. And you'll read about that in the book. And this is the one that we talk about in New Jersey, where this is what it is. Assume that every one of you is a town in New Jersey. And I'm the state, and I hold all your employees in the pension plan. Some of you have more assets than others, but with a cost-sharing plan, it's like buying an insurance policy or buying health care. It doesn't really matter. Your share doesn't matter. It's what your employees are going to receive based on the formula. Okay? So this cost-sharing plan, which you'll read about, is where each employer doesn't have to, and why I mention this is each employer doesn't have to in its book say, I have this many assets and these many liabilities for pension. They have no concern. They've just shifted the problem to the state. And that's called a cost-sharing plan. But if it's just an agent plan, where it's an aggregation, then you've got to worry about it. All right? But let's go back to this. Look at the assets, all financial assets, right? What's the net position of this pension plan? $146 million. Very straightforward balance sheet. Okay? Let's take a look at the statement of changes in net position itself. Look at the additions. Contributions from the employer, from the employees, investment income, there's a fair value of investment, investment and dividends, this is the addition. Deduction, these are the benefits that are paid. People who got disabled, payments made to retirees, refunds back to terminated employees who are leaving the pension fund, payments going back to them, and administrative expenses. And this number ties in with the pension. So why did I put this up? So you can see what kind of transaction happened in a pension plan itself. Now let's take a look at another schedule. Actually, you know what? We'll come back to this in a moment. What I want to show is this schedule. This is what I was talking to you about. In this case, the required contribution from the state, or for this was $13,615. If they contributed the entire amount, it's 100%. Not many places do that. In this case, they did, which means they are doing what they should be. In many cases, they contribute maybe 70%, 80%, or even less. Why? Because they have, as they say, more urgent needs. These are monies for what? Future, right? They say we'll get around to it, or maybe the stock market will bounce back and we'll make so much money that it will be overfunded. Okay. Well, they do plan for it in the budget in the beginning of the year, but remember it's a tough thing, because unless Congress passes a law which says that states must fund their pension plans, you know, if you're a private employer, you couldn't do that. Under federal law, you have to put in. You can't say, I'll give you the 8% later. You can't do that. Okay, so that's the issue which we have. Anyone care to guess what these pension liabilities are? How about like $3 trillion? This is the next huge public issue. $3 trillion worth of unfunded pension liabilities. And you know what? You can't say, oh, sorry, we have no money. Those folks have earned their benefits. It's it's too bad that you didn't put in your contribution, or the market came down, or you assume a high rate of return. Think about it. If I were the treasurer of the state or something, and said, how do I get my contribution low? By assuming a high rate of return. If I assumed a rate of 10% on my investment, is that a good number? No. And that's one of the GASB changes that they've come up with, is assuming a good return on investment. So let's talk about a couple of terms now, okay? The first one is the annual required contribution. Let me just go back and then we'll come back to this, all right? Actually, let me just go through this slide because this is that CBS story that I was telling you that I put in there. Basically what this says is, if you took your assets, pension assets, which is the actuarial value of asset, and divide that by the actuarial value of your liability, if it's 80% or better, you're okay. What would your answer be? I want it to be 100%. I don't want it to be 80%. That means I have what? 80 cents on the dollar, right? I want it to be 100%. But apparently, one of the indicators is if it's 80% or better, you've got a sound financial plan, okay? And another way to see if the pension plan is doing well is to remember the schedule of funding progress, which I just showed you, comparing the ARC to the amount that was actually contributed. Now, this is where things get interesting. Think for a moment the governmental funds, general fund balance sheet. What is that based on? Modified accrual basis, right? When the employer makes the payment for pension, that has to be shown on what? Modified accrual basis. Let's assume you were required to put $1 million, you only put $500,000. What would be your expenditure under the modified accrual basis? $500,000, because that's what you put in, right? What's your expense? $1 million. Where does the expense show up? In the government-wide statement. Because of that million and you only put 500,000, what happens? You just created a net pension obligation of 500,000. So pension, whenever somebody says pension amount, ask them, are you talking about expenditure or expense? Which is the number you really want to see? Pension expense, because that's what? On a full accrual basis, and that shows you the amount that should have been put in. Okay, and this is what we'll talk about. Let's talk about these couple of these other things here. Some of these terms. Okay. First of all, everybody understand what ARC means? This is the amount that's required from the employer. Okay, you get a bill, the actuary tells you you're supposed to put $100 million. Now, whether you put it or not, it's another business. Remember, GASB's concern is accounting and financial reporting. GASB is not going to force anyone to put in the amount that they should. That's a funding decision, a funding policy, different from accounting and financial reporting policy. I'll give you an interesting story now, a real life story. And I haven't told you about other post-employment benefits now, but I'll tell you right now. So this is what happens. When you retire, you receive a pension check, but there's something else you get, which is what? Health benefits for you and your dependents forever, till you live. I mean, till you die, right? You get those are your health benefits, right, for life. Did we put money aside for the health benefits? Nobody's talked about that. So pension accounting and other post-employment benefits accounting is very similar. It's just basically the same, which is, this is the other thing which nobody's ever even approached that. With pension, at least they're making attempts to put money, but with other post-employment benefits, they're saying, who knows in 25 years what the healthcare system would be. Let's not worry about it today. Okay? Because remember, the rule should always be, if an employee works this year, everything related to the cost of employing that employee should be recognized as an expense, which includes what? Their current compensation, their pension payment for that year, and their health benefits that they'll be provided in the future for that year. Okay? What happens is that they decided not to do that. So GASB came out with a statement which says, employers, if you do not recognize this as a liability, you saw that OPEB liability in the state was like 12 or 18 billion, right? If you don't recognize this, if you don't fund it, you have to show it as a long-term liability on your financial statement. Now, this is a true story. State of Texas, when GASB issued this statement, passed a law saying that no one in Texas, any town, municipality, school district, can follow GASB's rule on this issue. Why? Because of this huge liability would show up. They passed a law. Well, guess what happens now? So the municipalities and these say, well, we've got to follow the law. We can't follow GASB principles. Well, it wasn't too long because they went to him for an audit. And we haven't gotten to that chapter. It will be coming soon on governmental audits. And he says, governmental generally accepted accounting principles for governments require that you recognize the liability for OPEBs, other post-employment benefits. Where is it? Say, well, no, it's not here because the law says, our state law says, we can't put it. Say, but according to what I read here, I can only give you a clean opinion if you follow governmental GAAP, which is GASB. So guess what happens? Very quickly that faded because nobody would get a clean opinion. You don't get a clean opinion. What happens when you go out to sell bonds? It becomes a little difficult. So this is how upsetting some of these GASB principles are. And in fact, this statement 67 and 68, which I just gave you, has caused an uproar for the same reason, because they are forcing governments to show the true amount of liabilities that should be there. Remember NPO, which I just talked to you about? That's half the story. That's just amount that they have not contributed as opposed to what they should have. What about the stuff in the past? All that stuff is unfunded actuarial accrued liability, which is amortized over 30 years. GASB said no more. You need to recognize that too. So that's going to really cause governments to take a hit. And this is that number, by the way, unfunded actuarial liability, which is the present value of projected benefits other than normal costs. So what are normal costs? These are your annual actuarial present value of benefits for the current year. It's shown that way. A couple of other terms I already talked to you about: NPO, net pension obligation, annual pension costs. By the way, before I forget, there is a question that I assigned you, 8-9, on this one, but because the topic is changing, you don't have to do that question, 8-9, because unfortunately I picked the question which was the one which got most impacted by, so you don't have to do 8-9. Okay. So let's try to go back I want you to try to see if you can understand this. If you have never looked at this before, you're going to have a hard time. But just try to follow me, okay? Actuarial, first of all, see the history. It's over many years, 5 to 6 years, 5 years, other than the present year. What's the first column say? Actuarial value of assets, which is what? The plan assets, right? This is what I have. What's the next column? AAL entry age, and I'll talk to you about this. This is what are my liabilities, right? What's the amount overfunded or underfunded? That's what? AAL, which is difference between what I have as opposed to what my liabilities are, right? Boy, they turn things around a little bit, right? Okay. Funded ratio. Remember the ratio, which is what percentage of my pension is funded. Even though it's here, 107 drops down to 99.95 based on the side. Covered payroll, don't be too much concerned about this because this basically says that it gives you the total amount of payroll. Why? Because if you had to change the amount you collected, let's say you wanted to collect 1%. If you collected 1% on 10 million as opposed to 100 million, the relative amount, the absolute amount makes a difference, okay? And this is in relation to that. So this pension plan is doing quite well. Funded ratio of 80% or better is not bad. These are the three things that you should really understand the meaning of besides the funded ratio. Okay. Any questions on that, by the way? Okay, yeah. Because you know what? It's a good question. Why is it showing? Because it's not normal in pension plans to be overfunded. They're mostly underfunded. Excellent question. Yep. Yeah. Now let me just go back and I want you to understand a couple of other things. Okay? If you have a pension plan which is underfunded, what does it mean? You have a liability out there. Are you going to leave the liability there standing? What would you like to do? You like to take that liability and amortize it by putting more money into the plan, right? So the annual required contribution, therefore, is not only your current year's costs, but amortization of your unfunded accrued liability, okay? And the reason why I took that question off for you was because I really didn't want you to go into the depth that we have here. I want you to understand the meaning of the terms, but I don't want to hold you accountable for calculating some of these sums. I want you to understand the meaning of the terms. Everybody got that, right? Okay. If you were in my, not that I teach it, but if you're in our advanced governmental accounting class, not only would you be doing this, but you'd be doing research on how this would actually work. But that's for an advanced governmental accounting class. That's beyond the scope of this class, okay? Bless you. And as you can see, I love telling stories, and there are just so many great stories to tell, not only from around the country, but right here in New Jersey. And this is my last story to you. And it's a real story. Many, and I won't name the governor, many years ago, there was a governor in our state who had a brilliant idea. The treasurer had a brilliant idea. And this is what they thought of. He had a pension plan. They needed money for a tax cut. They needed to pay for it. Well, they needed a source of income. So this is what the brilliant idea was. I go out and borrow money. Taxable, not non-taxable, because non-taxable means it has to be used for some specific purpose. Taxable money. I go out and borrow $600 million. I borrow it, and I don't remember the rate. Let's just say 5%, taxable rate. Take that money and invest it in the stock market at 8%. What's my assumed rate of return now? 8% on my pension fund, which means I kick up the rate of return on my investment on my pension fund, and my contribution comes down. They had this figured out. Well, now tell me one thing. Anything wrong with this scheme? Sounds like a brilliant move. I'm borrowing money at 5% and investing in the stock market at 8%. What do you think? What's the risk? All right, and you know what? That's exactly what happened. It went okay for a while, and then what happened? Took a dive. And now let's assume that you got only a return of 2%. What are you paying now? 5%. So instead of the pension fund going up, what is it happening now? It's doing exactly the opposite. They were called pension obligation bonds. And you know what? A lot of us remember those bonds. And but that's, so when things look too good to be true, they're usually not, okay? And this was a classic example of using this strategy to boost up investment. Now, GASB just came up with new standards which basically say that if a plan is underfunded, you can't use a market rate of return. You have to use, and I won't go into this, a tax equivalent municipal yield. And again, I won't go into that, but basically a very low rate of return. When you use a low rate of return, you have to put more money into the fund itself. Okay. I told you about when we recognize pension expenditures, we need to show on the modified accrual basis what the amount, the actual was contributed. At the government-wide level, it would be the expense itself. Okay. You can read this on your own. NPOs, it has to be allocated. I want to get to a couple of other things before we stop. Let's see, anything else here? Note disclosures. What I'd like you to do is when you look at CAFR, pay particular attention to the pension issue, because that's so germane to our discussion. OPEB liability, more than $1 billion, trillion. I already spoke to you about what that is. Other post-employment benefits, it's huge, and we haven't put anything in it. Okay. And this thing about managing investment trust, and this is, we can talk about, this is a whole class by itself. I won't hold you accountable for this topic, which is managing investment trust funds. So let's take a look at some of our fun questions here. Okay. Still have time? Good. Because I like to do one more thing. Any questions on this? So definitions, how this works. I tried to give you a general perspective of what it is. It's really a very interesting area. And it's so timely right now because of the issues involved. Okay, let's get our thing out there, and let's get our polling equipment out. And I'd like you to see if you can answer. Oops, sorry. Can you read this? Okay. Guys, can you read it at the back? No? Okay. Okay. How are we doing there? What do you think? All right. Are we done? We got a few more, right? Okay. Let's do this. Everybody done? Okay. All right. Good. It is agency funds. That's all. Couldn't be anything more than that. Okay. Let's take a look at the next one. If you don't understand, stop me, please. How are we doing? A few more minutes to go. Let's keep on going here, okay? All right. I think that's it, 55, okay. Actually, good, but not good enough. Okay, how are we doing there? Let's. Got a few more. Okay, one more. All right. Excellent. Much better. We're doing better. Okay. Everybody see why it is that? Oh, sorry. Yeah. Good. Thanks. Okay, two more. All right. Well, excellent. Actually, it is permanent fund. Everybody see why it is? All right. That's too easy. This one's too easy. We won't do this one. Everybody know the answer to that, right? Okay, we won't do that. I want you to read each of the answers very carefully. I know this is new, but use process of elimination if you have to. Okay, how are you doing? You got still one more. Okay. All right. What do you think? Why did you answer D, by the way? Let's take a look at the answer. An expense of the general fund. Expense or some other term? Another financing use of a proprietary fund. Financing use, proprietary fund. Revenue of the PRS. Do we have revenues or additions? Okay. And that's why an addition to the net position of the PRS. So those are our questions. Well, let me give you one more since you're so good at this. We still have a few minutes, okay? This tests your memory as to what I just said in the class. Whether you're listening. All right? Okay, that's all right. I'll wait. Waiting for our last person. Oh, wait a minute. There was another person heading back there who hasn't responded so far. Wow, what happened here? Okay. Well, actually some of you, 45% of you did listen to what I said, which was the accounting is very similar. Remember I said that to you right in the class. Is very similar to that of the pension plan itself. So, okay, so this is your game plan for Chapter 8. Remember the change in the assignment, the last one you're not supposed to do. And when you review this material, please make sure that you get, especially for the pension, those concepts down, the definitions of what they are, because I wish I had more time to spend on it, but we didn't spend enough. And have a great weekend, and I'll see you on Monday.